Good morning. Welcome to the Morning Market Briefing. Today is Wednesday, June 10th, 2026. No World Cup predictions today. No World Cup predictions. We will get World Cup predictions tomorrow. We have
But
a
not
lot to
from
get
me.
to today, though. However, we do have CPI coming in as we speak. We also have an update on Iran, update on all the AI supply that's coming to market. We have another big stock offering. A company's going to dilute its shareholders by 30%. It is a $25 billion company. Or at least it was. We also have TSMC sales that we're going to get into as well and discuss. But first, Tom, I was up very early this morning. The markets were relatively subdued. We were just seeing a continuation of the tech sell-off that we saw yesterday. And then we got truth bombed at 7:03 a.m. And we can pull this up.
Pun intended.
Producer Hicks. Iran's military says the president is a complete and total mess. Much of it, like their Navy and Air Force, doesn't exist anymore. And then he continues, and the most important piece is that there is no peace. He says they've taken too long to negotiate. Now they will have to pay the price. In comments to Fox News, the president said that negotiations are continuing, but he is very, very, very close to issuing new strikes. And Israel, in some of its talk early this morning, has also said, unsurprisingly, that they would be all too eager to join in. So that's where we are, and we're selling off across the market now, not just tech, but really across sectors. The only one, at least when I checked earlier, that was spared was healthcare.
Yeah, so it's, the thing is, there was a pretty notable exchange last night. There was a U.S. Apache helicopter shot down. There were two servicemen who I guess allegedly were picked up by some sort of autonomous drone, which is pretty wild. I mean, this is like some sci-fi technology, but they were, I guess, unharmed, but they got picked up by drones. And that was the rescue mission, which added to the list of wild things that have happened since the beginning of the war in Iran. Ben, do you think we'd be worse off if prior to the ceasefire, we had just done the nuclear option and bombed all our bridges, infrastructure, and power and water? I tend to think no. I tend to think that actually was the right decision, and that this has just been an opportunity for Iran to gain more sympathy from people who have no idea how the world works, work on, beefing up their defenses, take a stronger hold on the Strait of Hormuz, and make things more difficult for the U.S.
I think Iran would obviously be in an inferior position. I don't think we would be in a better position.
I disagree, but that's just my opinion. We got CPI coming in, and
yes, so it's coming in, and it looks like we're slightly softer on the core, but in terms of the headline, we have our first 4% reading in quite some time. So I do think this will be short-lived in terms of 4%, and I think we're going to go pretty quickly back down. I think this is the peak of inflation. But Tom, what are your thoughts?
I mean, my initial thoughts is this pretty much played out like we thought. That the core might be actually much colder than people thought because there is no gas component. That it seems like X energy, things are really starting to turn over. I think there's just so many pieces that are indicating that the data is incorrect. I mean, I don't think that the headline of 4.2, I think that checks out. I think energy prices have risen. I think they were rising the most last month, and that number has come down and been sustainably lower for another month. So I think that there could be a substantial drop-off heading into we'll get it in July, but the June reading is going to be much lower. And if core is at 2.9 and then we suddenly see, the headline number drop from 4.2 back to, call it 3.6 next month, this bond sell-off is greatly overdone. So I still think it's an opportunity. Initially, we're seeing a little bit of a stronger sell-off in bonds. The 10-year was kind of around a 4.54, kind of bouncing around there before. Initially, we saw a little bit of a green reaction as the numbers came out, but we're basically flat now, 4.52 on the 10-year. Let's take a look at world interest rate probabilities. So heading into the call, the expectation was for a hike in December. 1.04 hikes were anticipated for this year. We're now at 1.038. So not much has changed. I would still say that that number should be far more towards the cut line. But, again, we're going to have to see that number come down on housing in order for that to happen. But where are we not restrictive on rates? That's where I'd like to know.
Yeah, and in what areas are we seeing inflation that rates would help? I think airfares, cutting interest rates would not influence airfares. I mean, airfares right now are just a pass-through of the oil prices. They were up 27% on a year-over-year basis, and that's really dragging up. Even though it's a small component, it's really dragging up the overall CPI index. We also have owner's equivalent rent, so you might say, well, if owner's equivalent rent is up 3.3%, then rates are a great way to bring down home prices. But I would argue that owner's equivalent rent is incorrect. It's not 3.3%. It's probably closer to 0.5%, Tom. And then you look at other places where we're seeing inflation. You saw big inflation in the last month in hospital-related services. Again, interest rates don't influence that. In fact, most hospital operators are very heavily indebted. So you think about companies like HCA Healthcare or Tenet Healthcare, or certainly a lot of the municipal nonprofit hospital systems there. It's so in debt they go bankrupt every 5 seconds. High interest rates mandates higher prices. So they're only going to want to charge more for it's counterintuitive, but higher interest rates actually create higher prices for on the hospital side. And that's where we're seeing some inflation as well. In the last month, we saw really an inflation across the hospital service space, but particularly within the hospital, inpatient services, et cetera. So, and outpatient as well. I mean, it's just everywhere. So I don't know if that's a calculation misstep by the BLS or how that's happening. Certainly, when I look at a lot of these companies that are reporting, they're not seeing 6% inflation in hospital services and price per admission, revenue per admission. That doesn't mean it's not happening, but I think that there's a little bit of a communication issue there with the BLS in terms of calculating that number. So ultimately, I think this is probably the high water mark in terms of inflation, and I don't think that lowering interest rates would really accelerate inflation. In fact, it may actually help promote a disinflationary environment.
I mean, it's just crazy. If you look at the shelter reads this year, positive 0.4, 0.2, 0.2, 0.3, 0.6, 0.3. It's continuing to get worse, and yet the numbers are, for the most part, the highest numbers have been towards the last 3 months on the shelter read. I just don't understand where they're getting this number. I mean, you look everywhere, and the cost of housing is going down, particularly in the hottest markets. We've talked about it a zillion times. San Francisco, Austin, New York, all cratering, and yet somehow we're getting 3.4% annualized on the shelter number. Like, if that was just zero, we would be at 2% inflation, even with the added effect of a 4% increase month over month on energy, 6.7 on gas. I mean, we would basically be at 2% right there, And so I think that, if the core is 2.9, but we're running shelter at 3.4, you take that shelter piece out, and we need to be cutting interest rates. We need to be cutting them aggressively. If you look at the anecdotal data, which is that we're seeing jobs get cut everywhere. We're seeing, we're seeing the housing market fall. I mean, but all you hear is, well, housing market is very strong, jobs market is very strong, but those don't line up with reality. You look around and that's not reality. I don't know anybody who's just like, man, I'm just, lined up with recruiters trying to take my pick of the litter of just getting this massive new job. And even in the data we got today, I'll have to go back to it here on Bloomberg, but one of the numbers, real average hourly earnings year over year, negative 0.7% month over month. That's not inflationary. Real average weekly earnings year over year, negative 0.4% month over month. And that's off of negative 0.3 last month and negative 0.2. So wage inflation is actually wage deflation. So tell me that's a strong jobs market where everybody's there was 200,000 jobs last month. It's just not true.
And that's going to result in pullbacks in consumer spending. Now, a lot of the consumer spending is kind of locked in, normal products that you have to buy, paper towels and food and groceries and a lot of utility services. That's all what you just have to buy. So that's all baked into the consumer basket. So you can't really pull back too much. But at the margin, you're going to, and we're already seeing that at restaurants. People are mixing down. And I think that a lot of the jobs numbers that we're seeing are indeed related to some of the build outs and pull forwards related to the World Cup. Remember that not a lot of construction is going to happen over the next month and a half, because in many places and in many construction verticals, you're not allowed to have construction in big cities near any of the stadiums, because they don't want to create added traffic burdens. And so they're really kind of putting the kibosh on that. And so you're having a pull forward in construction work. You're having a pull forward in hiring, because you got to hire for the service workers at the hotels, at the restaurants, at the stadiums. All of these things you have to do. You can't do it on the day of the game. You've got to do it the month before and prep for that. And all that's going to roll off in July. And I just think when we get to July, you're going to be in a situation where inflation is rolling over. I think May was probably the top. Like, this is probably the highest CPI print we'll have hopefully for a long time. And I think that, you can see growth start to roll over. We haven't seen that yet. American Express came out at a conference yesterday, said that they're actually tracking a little bit ahead of their expectation for the quarter. But I am watching this, because I do think that not a lot of people are talking about it. They're talking about the strength of the jobs market and should we be hiking rates. And I think that that's probably the wrong conclusion to draw.
Yeah, I mean, if you look down the list, inflation is only really expanding in energy and in shelter. One of those is wrong. The other is based on a war 6,000 miles from here. Everything else seems to be either muted or not really rising at all. And so the argument that inflation is going to run out of control is just not true. And if you see either reality come home to roost on homes or energy prices come back into a normal level, we are tremendously sold off on bonds. It's such an opportunity. And honestly, right now, while we're seeing the tech sector start to falter, I mean, if you look at performance of the S&P 500 in the last 60 days, it's almost entirely the tech sector. The rest of the market is virtually flat. That's not a healthy. We talk about big breath all the time on the call and in normal conversation, and we don't have it right now. And you're starting to see
up
that
and down.
Yeah, up and down. It's just not. It's not holding. This market's not holding. And we've been advocating for weeks now, trim and buy bonds, trim by bonds. If we hit a wall and we see these numbers fall apart, we see energy prices go back down, we see shelter prices hit reality, we're going to be at 2% inflation, and the expectations for hikes are going to swing wildly back the other direction, and we're going to see the 2-year drop, we're going to see the 10-year drop, we're going to see the 30-year drop, and there's going to be massive returns on bonds and probably not the equity returns that you would think. And I mean, it's just how it's going to be. It's going to look more like January when the stock market was down and the bond market was up. Mm-hmm. And we talked about at the beginning of the year, it's still not outside the realm of possibilities that bonds could outperform equities this year, even though we've had a really hot market for the last 60 days. A lot of that has just been, smoke and mirrors, and companies that were not profitable 3 quarters ago suddenly making a ton of money on AI. But, what if Meta decides we don't need all that compute? We're actually going to start selling that compute to somebody else. I mean, look at Google buying compute from SpaceX now. And they don't have to do all the CapEx because they've got excess capacity. And they cut those CapEx numbers. What is Micron going to do? What are all these chip makers going to do? Where they're going to tank because suddenly that demand's not there anymore. And they go back to being companies that aren't profitable and they can't push price like they were. The Korean stock market is dead after that. SK Hynix is going to return to being a non-trillion-dollar company, and interest rates are going to plummet. I mean, that's a very real scenario that I feel like is just completely off the radar of what anyone's talking about right now.
Yeah, and I mean, to be clear, I think that this is not something that we're betting the farm on, but I think that as we consider trading in client portfolios, I mean, this is something that we definitely consider, and we're not whistling by the graveyard right now. We're taking this very, very seriously. And There's certainly penalties to making a big call like that, i.e., probably being flat to down for the past 3 years instead of up 20% a year. But then by the contrast, you got to be alert to when those things change. And so we're just trying to watch the signs here, and we're seeing more signs than we had previously, which isn't to say that the economy is going to fall or even that any of these stocks are going to crash. But it is to say that these are things that we're watching.
I mean, if the narrative is true that the people who are most concerned with the price of Bitcoin have exited Bitcoin, which now is right around $60,000 a coin. So, call it down 50% from highs. And those people have moved into chip stocks because they know they can't lose. Well, can't lose on Bitcoin too. These are the same people piling lots of money, even if there's just a lot of people with not that much money piling into them. Once that turns, and they realize that they can't win every day buying AMD is going to go the way of Bitcoin. It's going to go back to being a pretty pedestrian stock, and that's going to push the markets down because it's been such a runner that it now represents a large portion of the S&P 500. It's not GameStop; it's a much larger company with the same level of hype.
Hicks, can we pull up the sovereign debt chart? This is a chart they were talking about on Bloomberg, so I thought it might be worthwhile putting in. But they were talking about how there's been a ton of issuance year to date from France and Germany and Spain and the UK in terms of sovereign bonds. And you have seen the sovereign bond issuance surge, and it's up about $70 billion on a year-over-year basis. And they're talking about that that's a whole lot more supply. We all know the bond market is larger than the stock market. I'm just postulating this, but the SpaceX IPO alone is more than the additional sovereign bond debt issuance this year. And they're already talking about how that issuance is freaking out bond markets. So you have the SpaceX at 75 to 80 billion. You have Google at 80 billion. You now have SMCI. They came out with this press release last night. It's a $24 billion company. They're issuing $7 billion worth of stock. The math means that essentially if you had owned 1/6 of the company before, 18.5%, you now own 1/8, 12.5%. You've just been diluted by a third overnight. Because SMCI is raising capital when they can, not when they need it. And you've seen that at Google. Perplexity is coming public. They just said that they're going to come public in 2028. OpenAI filed for its IPO. And SpaceX, all these shares are going to dribble out. This is not 80 billion and stop. We have another $1.6 trillion that is going to dribble out over the next year in SpaceX stock. Not to mention Anthropic, not to mention OpenAI. And we're talking about how $70 billion of additional issuance in the bond market can influence rates.
That's the dumbest thing I've ever heard. Because, first of all, we're $35 trillion plus just of treasuries. That doesn't include all of your mortgages, all of your muni bonds, all of your corporate debt. And that's just the U.S. Credit cards, all your ABS, think planes, trains, and automobiles. So you're looking at what? A market that just in the U.S. is well over $100 trillion. $70 billion is nothing. I mean, it's absolutely nothing. It's a drop. But, the total market cap of the S&P 500, you start adding trillions of dollars there, and suddenly there are a lot more stocks chasing after the same number of dollars, and it's really going to influence these people who are all piling into one stock or the other to try and chase it. I mean, you might see SpaceX pop, but then the Anthropic's going to IPO. Anduril is coming down the pipe somewhere to IPO. And that's another one that is very online, very visible in the Twitter sphere that people are excited about. I mean, there's going to be a zillion different things to chase. I think we just get maximum volatility towards the end of the year. And
so you have supply and demand of money. And ultimately, that's what determines interest rates and on a market basis. And right now, there's a lot of demand for money, and the demand is going to continue to increase. Because you need cash to buy all this stuff. So the demand for cash is high. And the supply for cash, as long as the Fed remains restricted, is low. And so what does this mean? If you have low supply and high demand, rates, it's going to influence rates higher regardless of what you think inflation's going to do. That's going to be restrictive. So the only way that you can offset that, if you're the Fed, is to match the demand. And that's what the Fed should do, is the Fed should say there's a lot of demand for money. As long as it's not going into really bad things, let's increase the supply of money. Let's lower interest rates. But I don't know if that's... Warsh has a big ship that he needs to turn around, and the other constituents, other members of the Fed. And it's going to be tough to convince them of that.
Because they're dumb. And that's the unfortunate truth, I think. Because they look at this data and they think, oh, housing's up? Okay. Well, we shouldn't cut rates.
We saw an article yesterday, and there was a quote from a fund manager. And this fund manager said, show me where rates are actually having a restrictive impact on the market right now.
Yeah. I mean, I don't know how many primary residences that Lisa Cook has. It's at least 2 in 2 different cities where she lives full time. But I can't imagine that she's unaware that the value of those is going down. But I would guess she's probably the most fervent supporter of raising interest rates right now.
It'll be very interesting to see what Oracle says tonight. Oracle does report earnings later tonight. We have a federal budget balance coming at 2 p.m. Right now, Oracle's CapEx expectation for the next fiscal year is $50 billion.
Keyword is for now. Let's really hone in on that.
They're gonna spend $18 billion this quarter. Yeesh. They're gonna be over 50.
Yeah. If not 80 at that rate. I mean, 18 in this quarter, that number's probably not going down for the next quarter. And if you, so say you do 18, 24, 30, you're at 80 bill real fast.
Yep. You might get 80 billion in 3 quarters.
Yeah. So.
All right. That's all we have today. Wednesday, June 10th. We'll be back here tomorrow. It is Tomorrow Day, which means it's Burrito Day tomorrow at the office. So, regardless of what happens in the market, at least we have that going for us, which is nice, as they say.
Strap in, folks.
Have a great day. Let us know if you have any questions, and we'll see you tomorrow. Bye.